Assalamualaikum. My name is NURUL FITRAH binti MUHAMAD JAFRI and I am from JBA 2423E. Today, I will be presenting the topic 3 and 4, which is the concept of capital structure. In an era that requires one business to compete with other businesses, every company must learn, explore and deepen the knowledge of how to keep the business thriving to the better. Therefore, in this presentation, I will further explain about various changes of capital structure that can affect the firm's value either positively or negatively. Capital structure research seeks to explain the combination of stocks or securities and sources that companies use to finance their actual investment. In other words, it is a mix of debt and equity used by the company to fund their overall business and growth. Equity is represented by common stock, preferred stock, and retained earnings, while debt is represented by bond issues or loans. But short-term debt is also included in the capital structure. For example, banknotes where it is placed under current liabilities on the balance sheet. The capital structure should be wisely planned by the business leaders either in small or large corporations so the company could perceive and monitor which capital structures give the best contributions to their operations. For example, debt financing. The company should ask themselves, do they have to use more debt and at the same time earn higher returns, or is it better to go for equity financing where they can minimize the risk of huge debts and bankruptcy? The primary goal of the corporate finance department is to find and determine the optimal capital structure that leads to maximizing the value of the company's assets or wealth and minimizing weighted average cost of capital. The optimal capital structure can be estimated by calculating the combination of debt and equity that helps in maximizing its market value and minimizing the WACC. Since determining optimal capital structure is quite challenging and difficult for them. Therefore, managers usually would continue operating and running the company within a range of value. For example, when the company wants to make plans, they have to consider its cost of capital and decided on how to earn a greater return than their own cost of capital in order to make the investment worthwhile. Moreover, to determine optimal capital structure, a company with good and promising prospect will seek to raise capital through debt rather than equity so they can avoid any dilution. Why? Because there is no ownership stake provided by a loan and avoid transferring negative signals to the market. Usually, announcements about company incurring debt are regarded as positive news, which is known as debt signaling. Debt signaling is a financial theory that links a stock's future performance to any recent announcement about its debt. This is the reason why announcements about a company incurring debt are known as positive news, because they indicate the company is creditworthy and seeking capital for expansion. There are several factors that can affect the company's capital structure and its decision, and the first one is flotation cost. Flotation cost is a cost associated with the issuance of shares or debentures, where these costs include commission, brokerage, advertising, and the cost of underwriting. If the cost of floating equity is greater than the cost of floating debt, this may lead the financial manager to decide that debt financing can be considered as more cost-effective option. Next, we have companies' return on investment as important factor affecting capital structure and capital structure decision. Let's say, if the return on investment is greater than the interest rate, the company should prioritize debt in its capital structure. However, if the return on investment is lower than the interest rate paid on the debt, the company should avoid debt and rely on equity capital. If the return on investment remains constant, an increase in the cost of capital will reduce the profitability of the company and the shareholders' wealth. Furthermore, control also is one of the factors that affect a company's capital structure decision. The equity shareholders are the one that owns and have full control over the company as they make all the major and important decisions for the company's management. The preference shareholder got limited voting rights at the annual general meeting. However, if the company fails to pay a dividend to preference shareholders for an extended period, the preference shareholders are entitled to vote at the company's meeting. Meanwhile, the debentures holder have no say in the management. If the company pays its interest and loan installment on time, its creditors have no right to interfere with managerial decisions. Financial distress is a state in which a company is unable to generate enough income or revenue to pay and fulfill its financial obligations, where it usually happens due to high fixed costs, high degree or percentage of liquid assets, and revenue that is prone to economic downturns. Neglecting the sign of financial distress before they become out of control can be disastrous and devastating, because if the company's obligations have grown too large to be repaid, there may come a time when this problem cannot be remedied. We can also tell that the company is facing financial distress when they are unable to pay their financial obligations by the due date. For example, it includes financing such as interest on debt payments. Firms that are more likely to experience financial distress will borrow less than firms that are less likely to experience financial distress. This happens because financial distress can be expensive for some of the companies than for others, as the costs of financial distress are primarily determined by the firm's assets, depending on how easy the extent to transfer ownership to these assets. This subtopic discusses the tax effects and costs of financial distress where companies find it hard to pay back their obligations. Costs associated with financial distress include bankruptcy costs, direct costs and indirect costs, as well as the cost of a threatened firm, conflict of interest, and high level of cost of capital. The failure to lead the company very well will be resulting in poor operational and investment decisions due to conflict of interest rises between stockholders and bondholders. The integration of tax effects and financial cost distress is known as trade-off theory, where this theory helps in balancing the tax benefits of borrowing to the cost of financial distress. If low tax rates are imposed on dividends and capital gains, the tax advantage of corporate borrowed funds has diminished since the lesser tax paid by the investors on total income received, making it easier to raise capital through equity rather than debt. By looking at the graph, the value of a firm with corporate taxes and debt exceeds the value of a firm with no debt by the existence of the present value of the financial distress or interest tax shield on debt. As the firm started to borrow more, the PV rises until additional borrowing elevates the potential earnings of financial distress. From the graph also, the maximum value of the firm met the optimal amount of debt, which indicates the optimum value of borrowing. The optimal structure simply equalize, balance the additional gain from leverage as compared to additional financial distress costs. A firm may decide to borrow the fund as the tax shield is beneficial and useful to the company. As claimed by this theory, firms need to raise their debts until the value of the PV tax shield is slightly offset by rising PV costs due to financial difficulties. Agency cost of equity can be referred to the dispute of interest that emerge between shareholder, which is principal, and management, which is agent, and this conflict arises when both parties have different interests and preferences that result in biased action. In other words, shareholders view the decision made by the management will not bringing any benefits to their shares. The cost of equity in this wedding, the merger is lobbying. This cost will be borne by the shareholders if management's interests differ from those of the shareholders. Moreover, previous studies show that the cost of equity capital is often related to information asymmetry. It means that the companies are most likely to avoid and prevent issuing debt securities if the market has little knowledge or information about the company. Furthermore, by taking steps to encourage an agent to act in the best interest of the principal may also assist in relieving the issues associated with the agency costs. For example, performance-based compensation may help in motivating management or agent to act in the best interest of principals. It concerns on the short-term run, the tactical problem of raising external funding to finance its investment. The pecking order theory is considered as an alternative or another choice of the static theory where firms usually would prefer more to use internal financing to finance business activities through retained earnings. This is because to raise cash by selling securities can be costly. Therefore, it is better if the company avoids doing that to prevent any major losses. The pecking order theory emerged from the concept of asymmetric information, which is known as information failure, which happens when one party has more information than the other parties, resulting in a transaction power imbalance. For instance, the manager of the company usually has more information pertaining to the company's performances, risks, prospects, and future outlook than the external user. As a result, external user will ask for a higher return to compensate and mitigate the risks that they carry. There are several implications of the pecking order theory, which the first one is no target of capital structure. There is no target or optimal debt-equity ratio according to the pecking order theory. Instead, a firm can determine the capital structure by its need and requirement for external financing, which determines how much debt the firm will incur. For the next implication, less debt is used by profitable firms. As we already know, profitable businesses generate more internal cash flow, requiring less internal financing. As a result, they will be carrying less debt. For the last implication, company may demand financial slack. Financial slack is extra money or cash that companies have in case of a drop in sales, profit, or revenue, which helps the company to get through a rough situation or a difficult period. However, in this case, companies will choose to stockpile internally generated cash to avert from selling new equity. Apart from that, the pecking order theory also has several empirical evidence to share, which the first one is companies' profitability. According to pecking order theory, companies prefer internal financing when there is asymmetric information. There is an inverse relationship exists between a company's debt and profitability. Profitable companies are more likely to possess more retained earnings, as successful companies do not have to rely on external finance for too much. Next, in terms of the company size, to determine the company's profitability, we can see that there is a relation with the size of the company, where large firms are less likely to fail because they are more diverse than smaller firms. Lastly, for its tangible assets, indicate that the company will have a higher liquidation value and greater collateral if their tangible assets are higher. Based on the asymmetric information, the signaling hypothesis is predicated on the presumption that data and information that the company gains is not always accessible to all parties, and asymmetric information is the rule. Ross proposed the signaling theory, stating that the manager's decision of capital structure will signal the information to the market, and this occurs when managers possess inside information. The signaling hypothesis depicts a negative signal to be conveyed once investors interpret it as bad news, which is the reason why when the stock issue is declared, the stock price tends to be fall. On the other hand, the positive signal happens when the company declares regular dividends will be elevated. Next, by looking at the other context of signaling hypothesis, which firm value can be affected by the profitability and leverage. Miller and Modigliani have touched on the topic of information-contained dividend payments, where management's potential earnings influence their current dividend payout choices. Managers enter debt contracts to focus on making future interest payment, and the inability to repay the debts may result in bankruptcy. This gives the market sentiment that the firm has enough cash flow to support debt. In other words, higher financial leverage reduces a firm's value by increasing the likelihood of bankruptcy. In In conclusion, capital structure is important because it helps the company to understand its risk profile and its financial health.